Welcome to Chapter 1 of Staying Invested, the investment journey. This is about the cycle of emotions that you will undoubtedly feel during your investment journey, whether they are euphoric, when we are seeing good times in the markets, or when they are less so positive during market downturns. And it's important to make sure you can tame those emotions throughout your investment journey. I'm going to take you on a trip through your investment journey, showing you the highs and the lows that you're going to have to experience typically during a normal investment, long-term investment journey. The highs where you'll feel euphoric and the lows where you feel potentially capitulation. And it's important to understand this in order to tame your emotions and to avoid making any knee-jerk reactions. You've started your investment journey and markets are going up. It's been a good start. You've gone from optimism to excitement, thrill and euphoria. And this is against a backdrop of full employment in the US. It's also against a backdrop of central banks starting to cut interest rates. Similar echoes to where we could be in the next 6 to 12 months. Also, there is some darker things on the horizon, political issues regarding China war with US and China. And ironically, though, this is the point of maximum financial risk. This is a point where you do not want to be increasing your risk tolerance just because of your emotional feelings. We've now reached the top of the feel-good factor, and we're starting to come down the other side as we see reports of a virus outbreaking in Wuhan in China, and also a number of cases going across Europe and America. And you're starting to come down through anxiety, denial, fear, as you're missing those good feelings you had at the early part of your investment journey. You've now reached the bottom of your emotional spectrum through your investment journey, through depression, panic and capitulation. And this was during the height of the pandemic and also the trough of the markets as we saw a widespread pandemic of COVID-19 and we saw a market crash. Ironically, though, this is the point of maximum financial opportunity, the opposite to what we saw when we were at the height of euphoria. This is the point where you don't want to be taking any decisions to reduce your investment risk just because of the negative emotions that you are feeling. We then moved away from the bottom of the emotional market cycle as governments and central banks put in place stimulus measures to protect the most vulnerable, as well as protecting employees and companies from the ravages of COVID-19. That saw an increase from capitulation to hope and relief and back to optimism, filling in the cycle of the emotional journey for this short cycle that we had throughout 2020 and 2021. It's important to remember not to overreact when things are bad and also not to overreact when things are good, and keep a clear and open dialogue with your financial advisor. Where we currently stand is probably around the desperation and hope level. I would think we were probably in that orange segment throughout 2022, depression, panic and capitulation as inflation went ravage. And I think now in this part of the year, we're moving back up towards the optimistic part of the cycle. Hope you enjoyed this chapter, and please listen to the others. Welcome to Chapter 2 of Staying Invested. This is about the mosaic of annual returns. It's going to show you the importance of having an appropriately diversified portfolio because different asset classes at different times will behave differently. It doesn't mean the most prolific asset class in any one year will end up maintaining that track record. Typically you see a lot of volatility within the individual asset classes, and this is to show you the importance of having that spread of investments over your investment journey. Here you can see on the left-hand side we have 2011, all the way to the right-hand side we have 2022. And each column represents a calendar year, and you can see within those columns each asset class has been given a different color. So visually you can immediately see how different asset classes react in different years. And this just shows you the importance of not picking an individual horse in this long-term race, but having a diversified portfolio to give you that correct risk and return profile. I'm going to highlight the differences between different asset classes. If we take inflation, which was the best asset class in 2011, and map that throughout the period, you can see straight away that it was a fairly volatile period, being the best asset class in 2011, 2018 and 2022 last year, but also being one of the worst asset classes in between there as well. So you wouldn't want to be necessarily just investing in this single asset class. The same could be said if you looked at the worst asset class in 2011, which was global emerging market equities. It has a very rocky period as well. So just investing in that would also not be a good period. What you want to do, arguably, is have a diversified portfolio. Now we're taking into account our balanced level of risk. And here you can see that diversified portfolio, our balanced level of risk, takes away both the top and the bottom and gives you a much smoother, less volatile investment journey. And that's the key to long-term investing, is finding your level of attitude to risk and sticking to it. Hope you've enjoyed this chapter. Please listen in to the others. Hi, welcome to chapter 3 of Staying Invested. This chapter is about understanding that it is the best days that can drive your long-term future returns. But in order to do that, you have to stay invested in order to capture those best days. Market timing is almost impossible to do. So this is about making sure you stay invested to capture the best days. But on the flip side of that is to be comfortable with taking on those worst days as well. Here we have a table showing you the returns of the S&P 500. This is the main US index, and it's split into decades from the 1930s through to the 2010s. And you can see here particular decades have particular return profiles. But if you were staying invested, you're better off in both terms of having a less negative return or a better positive return. If you look at the 1930s, for example, this is during the Great Depression, that decade would have returned you minus 42%. But if you tried to time the market and you missed the best 10 days, that negative return would have doubled to almost minus 80. Conversely, during the 1990s, you can see your price return, the total return for that decade would have been over 300%. If you'd missed the best 10 days, though, that return almost halves. And it's the same for each decade. You can see here the cumulative loss of missing those best 10 days in each of the decades. So rather than trying to time the market, it's really important to stay invested, capture those best days, and be robust enough to suffer the worst days. Because typically those best days follow on from a bad day. Here we have a study showing you that it's important to take the good with the bad for better long-term returns. Here is an example of £10,000 being invested in the FTSE All-Share over a 20-year period running from 1998 to 2018. We thought it was also important to do this study before the COVID in order not to skew the results. If you invested that £10,000 over the 20-year period, you would have returned £31,350. This is staying invested for the entirety of that 20-year period, not trying to time the markets, not trying to dip in and out during good times or bad times. If you had tried to dip in and out and you happened to miss only the best 10 days, your return would have halved to only £15,000. If you happen to miss an additional 5 days, you're missing 15 days out of that entire 20-year journey, your return would have dropped to £12,500. Still a profit, but not significantly higher as you would have done if you'd have stayed invested. It only takes you to miss 25 days out of 20 years, and missing the best 25 days. That's less than 1% of your investment journey over that 20-year period for you to have made a loss. I think this starkly shows the importance of staying invested and capturing the best days in the stock market, which can often be following on from a bad day. So as we say, taking the good with the bad. Hope you've enjoyed this chapter, and please feel free to listen to the others. Welcome to chapter 4. This is about timing the markets and a bit more detail that they can seriously damage the wealth you're going to try and create over the long term. Here we have a chart showing you both the returns if you stayed invested, the cumulative return going back to 1936 all the way through to the end of 2021. And if you invested just $100 at that point, your cumulative return would have been $35,489. Pretty good. However, if you try to time the markets, and this is where it gets a little bit complicated, if you tried to time the markets and you were selling 10 months before a peak, because you felt markets were getting too high, too risky, and then buying 10 months after the trough, which seems a very sensible approach. You're missing the top, you're not buying in at the exact bottom, you've missed that drawdown going down. Your return is actually a third less. So the cumulative effect of trying to time the markets, and there's 12 different occasions here where you would have been selling before the peak and buying well after the trough, that your returns would be 3 times less than if you accepted that volatile journey of just staying invested. This is why it's important to listen to the previous chapters about the emotional roller coaster of highs and lows and the importance of staying invested. Hope you enjoyed this, and please listen to the other chapters. Welcome to chapter 5 of Staying Invested. This chapter is about showing you that the important factor is not when you start investing, but for how long you invest for. Even if you start off with necessarily a bad experience at the beginning, the longer you stay invested for, when you invested becomes less and less important. The key factor here is for how long you're investing for. We're going to show you an example here. This is portfolio 6 of our active model portfolio service. This has been running the longest. We're almost 20 years into this, and this is actual returns you would have received if you'd invested in portfolio risk 6. What we're showing you here is just a year's return. This is a rolling years. So here we have if you've been invested for a 12-month period, and that's going back to November 2004 all the way through to the end of 2022. And you can see here that at the best period you'd invested in, you'd have had a return of over 40%, and the worst period would have had a return of minus 29%. Ironically, the minus 29% would have been from April 08 to April 2009. This was the height of the global financial crisis. The next 12 months was the best period, from April 09 to April 2010. You can see, though, as you take a longer time period, the annualized returns reduce. The dispersion of those returns come down fairly dramatically. So already extending your time horizon from 12 months to 24 months has reduced the importance of when you start investing. Take that forward to 5 years, and you can see the dispersion here has dropped dramatically. So over this 5-year period, what we also have done is eradicate any negative returns. Take that forward to 10 years, and suddenly the importance of when you started investing reduces dramatically. What the key here is about how long you're investing for here. And you can see those 10-year annualized returns also include those annualized returns that you would have had if you'd had that 1-year time horizon as well. So again, does timing matter? No. What really matters is how long you're investing for. Long-term investors will pick up those rewards. And you take that through all the way through to 18 years. We have up to 18-year data towards the end of 2022. We're going to update this on an annual basis here. So the 18-year data, as you can see straight away, shows you when you start investing doesn't really matter. And the importance being as well, if we draw an orange line in here, the difference between the blue and the grey represents where the average sits. And the average is pretty steady whether you're investing for 1 year or for 18 years. And that gives you a higher sense of probability that the longer you invest for, the greater your chance of outsized returns. It's not just portfolio 6. This phenomenon goes through all the risk profiles. And we're going to take you through all the risk profiles now from risk profile 1, as you can see here, all the through to risk profile 10. Obviously, the one thing that does change is the level of return. The more risk you're taking, you're going to be rewarded with a high level of return. But what you're also seeing is for all of the risk profiles, the longer you stay invested, you're reducing the chance of having a bad period, and the averages are staying very similar across all the rolling periods within your risk tolerance. Hope you've enjoyed this chapter. Please feel free to look at the others. Welcome to chapter 6 of Staying Invested. This is about keeping the odds in your favour, showing you the probability of staying invested dramatically weighs in your favour the longer you stay invested for. And to demonstrate that, we're going to look at the FTSE All-Share, and we're going to look at it in calendar years. And you can see here from 1986 all the way through to 2022. And immediately you can see that around 70% of the time you're being delivered a positive return rather than a negative return only 1 in 3 times. However, the market does like to play with our emotions, as we've already seen through the previous chapters. And what we're identifying here with the orange dots are the low points in any particular one calendar year. Now, the key to remember here is if you stayed invested for that entire calendar period, you get a return that is better than that low point. If you take 1987, for example, on the left-hand side, you can see here the low point was around minus 38%. However, if you'd stayed invested for the entire year, you got a return that was positive. So more often than not, your point of capitulation, that low point, is going to be significantly lower than the actual return if you'd stayed invested. Sometimes it means a less negative return, but more often than not, it actually means a more positive return going forward. So staying invested, being resilient, being robust, gives you a higher probability of longer-term returns. If you were to lock in those negative returns and capitulate it at every low point, that is an average per annum return of minus 15%. Whereas for the FTSE All-Share, staying invested for those longer returns gives you a plus 6% per annum return. You've just seen the returns for the index for the FTSE All-Share. What we're going to show you now, the actual calendar year returns from risk profile 1 through to 10 for our active MPS. I'm going to pause here at Portfolio 6 because we had another example where we looked at the rolling returns in more detail for Portfolio 6. And here you can see that similar pattern to the FTSE All-Share. Vast majority of the returns are positive. We've only had, 5 negative year returns out of the 18, so that's extremely good. But the most important thing here to look at as well, sometimes those low points, those points of a capitulation, are actually 0. So if you look at 2006, you look at 12 and 13 and 17 and 19, all of those periods didn't provide you a negative return. So you didn't actually have a point of capitulation. Finishing on risk profile 10, obviously the returns are significantly higher and some of those points of capitulation are significantly lower, but a better profile than if you just invested in the FTSE All Share. So stay invested for putting the odds of probability in your favour. Thank you for listening to this chapter. Please feel free to listen to the others. Welcome to chapter 7 of Staying Invested. This is about understanding that the good times last longer than the bad periods, although we're going to feel the bad periods hurt more than the good times give us the benefits. We're going to go through the bad times first. Here we have the S&P 500 since 1958, and we've had 10 bear markets. And a bear market is represented by a drop of more than 20% from its previous market high. So of those 10 periods, on average, the drop has been around 37%, minus 37%, and the duration has been roughly around 14 months. They can last a bit longer, or they can be a lot shorter. The most two recent bear markets we've had have been considerably shorter. Here we have the opposite side of the coin, the bull markets. What represents a bull market is the opposite of the bear market. It's a plus of 20% from a previous market trough. And again, since 1958, we have had 10 bull markets. So 10 bear markets, 10 bull markets. But the bull markets tend to last considerably longer period of time, typically over 5 years in duration compared to only 14 months on average for the bear markets, and there's an increase of over 180% on average, whereas the bear markets tend to drop. The problem being is we tend to feel the pain of the bear market 2.5 times more than we feel the gain, the pleasure from a bull market going upwards. Hence why it's important to make sure we stay invested over the long term and get in control of our emotions. If we put the bear markets and the bull markets together, you can see the patterns of the ups and downs. Yes, the bear markets are shorter in duration, but the bull markets tend to last a lot longer and give you that growth return for that. The problem being, though, as we've already identified, that bear markets hurt more, and that's when we tend to have the market reactions. The key here is to stay invested, control, tame those emotions, keep that open dialogue with your financial advisor to help you navigate through your long-term investment. Hope you've enjoyed this chapter, and please feel free to listen to the others. Welcome to chapter 8 of Staying Invested. This is about showing you the consistency of returns that you're likely to receive by staying invested for the long term. What we've done here is broken down the quarterly returns into different segments. On the left hand side you have the red segments, and the segments are 0 to -5, -5 to -10, and worse than -10. On the right hand side we have the positive segments. They're in green, and we have from 0 to +5, from +5 to +10, and greater than +10. Straight away you should be able to see that the green sides significantly outweigh the red side, so the probability of receiving a positive return is significantly higher than a negative return. As you go up the risk profile as well, you will see that the segments of pluses and minuses spread out to give you that normal distribution. So portfolio 1, most of its returns are within the segments 0 to -5 and 0 to +5, whereas portfolio 10 has a significant portion of its returns in segments that are worse than -10, but also more positive than +10. What we've done here is taken the return profiles and trying to give clients an expectation of what they can expect to receive in the long run. And what we've done is taken those first two segments. We've taken the first negative and the first positive to give you a range of between +5 and -5. And how often, based on your risk profile, are you going to fall in between +5 and -5? And you can see straight away, the less risk you take, the more probability of your return is falling between +5 and -5. Taken to the extreme, risk portfolio 1, there's only been one occasion where the return has fallen outside of +5 to -5. Whereas portfolio 10, only half of that return will be between +5 and -5. Sometimes it will be worse than -5. More often though, it's better than +5. So this gives you an indication of, based on your level of risk, how often your expectation will be of getting a return of between +5 and -5. The key question for all clients is how often can they expect to receive a positive return? And what we've done here is take across risk profiles 1 to 10 and average them across all of those risk profiles for the period in question. And if you're only invested for a quarter, you can see here that 73% of the time you can expect to receive a positive return. Increase that to a year, that probability goes up to 80%. Increase it to 3 years, that probability of receiving a positive return goes up to 89%. And if you invest for 5 years, the probability of getting a positive return goes up to 100%, showing you the longer you're invested for, the greater the probability you're going to receive a positive return. Thank you for listening to this chapter. Please feel free to listen to the other chapters in this series. Welcome to chapter 9 of Staying Invested. In this chapter, we're going to go through and show you 2022 in context to the other years we've been invested. We're going to show you each risk profile from 1 to 10 and the quarterly returns in order of magnitude. So you can see from the highest to the lowest. You can see exactly where 2022 fit within the rest of the period we've been invested. Starting with portfolio 1, you can see here there's 73 quarterly returns, and over that period the vast majority have been positive. It's around 70%, and it's around 70% for all of the portfolios. You can see here though that the first 3 quarters of 2022 both fell into the negative areas. First time we've ever had 3 consecutive negative periods within a calendar year. More positively though, the last quarter of the year was positive, as has been the first quarter of 2023. Pattern repeats for portfolio 2 is actually the same for all of the portfolios throughout that. First 3 quarters being negative, with the final quarter being positive, just showing you how difficult a period it was for navigating in 2022. The key elements were making sure you were diversified, and our portfolios are, making sure you stayed invested as well. Here you can see the pattern remains for portfolio 10. First 3 quarters negative, albeit the third quarter only slightly negative, and that was true for the majority of the portfolios, and the last quarter being positive. It's quite nice to know also the first quarter of 2023 is positive as well at time of the recording. Thank you for listening. I hope you've enjoyed the remaining of the chapters. If you do have any questions, please reach out to your financial advisor. And stay invested. Thank you.